Our special guest right now, they're joining us today for Trader Talk, are Matt Bowen of IndicatorWarehouse.com and Steve Thompson, who is a DTI student. That's www.dtitrader.com. I know some of you guys probably had the opportunity that are Trading Pub regulars. You guys got to hear Matt speak a couple Saturdays ago about risk management, and he did an excellent job there. And then Steve's going to be sharing about some things that he's learned as a student of the markets. They both have pretty interesting backgrounds. Let me tell you a little bit about them. Matt actually first learned about the markets from his grandfather, who's a portfolio manager. He's got a diversified background in finance. He specializes in portfolio risk management, and his area of focus is day trading, fund management, and software sales. He's a consultant and contractor, or has been a consultant and contractor to major trading software companies and capital management firms, and he's an active proponent of risk-reward trading and the use of those principal concepts to maximize sustainable profit. So Matt really has a focus on risk management, and I think anybody that's been around as long as he has and been around the markets a long time understands that one of the most important things, if not the most important thing, is going to be managing that risk, and that's especially prevalent in today's market. Steve Thompson has over 30 years experience in banking, real estate, strategic planning, and business development on a national and international basis, and he has a very diverse background, from a senior executive at Citibank, Sears Financial, Mercantile Bank, and offshore investment funds. He holds an MBA from Pepperdine. So Steve came in from the academic and business side of the investment world, and since 2006 he's really tried to learn more and more about trading and become a professional trader. So he began his education with DTI since 2006, and a lot of you guys with DTI are familiar with Steve. He's a regular in the trade room over at DTI, and I know a lot of people that know Steve probably wonder when he sleeps. It seems like he's up just about 24 hours a day. So real quick, give me a second. I'm going to get these guys dialed in, and we'll go forward with the presentation.
All right, well, good. Well, Matt and Steve, we just gave them a quick little background to how you two guys got started in trading and the different things that you focus on. So they're a little bit familiar with your story, but if you can real quick, and Matt, we'll start with you, just give them a quick synopsis of how you got started in trading.
I got started through my grandfather. He was actually a portfolio manager, and I grew up in the business, literally going around to different, meeting with clients, explaining to them, how the risk management process works, because that's really what I focus on. My whole forte is risk management, and I set up trend following systems, for those clients. Basically, how I got into the business was my grandfather kind of threw me in the water and wanted to see if I could swim, and I failed miserably. Actually, he gave me 3 accounts, and I blew them all out, and it was a quick wake-up call. So he told me, he says, why don't you become a broker and learn a little bit more about the business, learn how, people interact in the business, and that's what I did. So I spent 2 years in the brokerage business, and that was a huge wake-up call as well. So as time went on, I worked with my grandfather. He taught me the ropes. He was a ticker tape reader, so he was going back years, and that system just didn't work for me. So we're talking early 80s. Technical analysis was just coming onto the screen. People just started to have computers and person. So as soon as I got the chance to see charts, a whole world opened up for me, because I couldn't read a ticker tape to save. And back then, you just had the scrolling tape at the bottom. But he used to be able to, read the block trades that were going through. And I'm a horrible math person, so I can't add this stuff up. So I had to find a way to do it on my own in a different way, and that's how I got into technical analysis. So, I think everybody has a different route that they take. Most people that are in technical analysis are visual-oriented thinkers, so we all have a common ground there, and that's basically my story. And the way I became successful was, like I said, I failed miserably in the beginning, and I had to find a mentor. And it wasn't until I found a mentor who showed me exactly how to work the business that I was able to become profitable. So, you know, if you're not doing well at it, that doesn't mean you're going to fail as a trader. There's always a way to figure it out. You just have to find somebody that knows what they're doing, and then repeat what they do. It's kind of like there's a learning tool out there called NLP, which is neuro linguistic programming, and basically all that is modeling. You go find somebody that's doing something successful, and then you model it. You just do what they do and repeat it, and that will work. You just have to find somebody that knows what they're doing. So, you know, I have a long story. There's a long 10-year period there where, you know, nothing worked for me, and I had to figure it out. But basically, it was finding somebody that knew what they were doing and then replicating that. So.
Okay, great. Well, thanks for sharing that. And Steve, if you can share a little bit about how you got started in trading.
Well, certainly. Mine was a little different. Mine was sort of backwards. I've been aware of the markets for 30-some years, but not as a trader. I started in the banking, mortgage banking, real estate industry about 30 years ago. And while I was in the mortgage business early on, we had one little screen. I laugh sometimes when Tom and Bill Kostarides talk about the Globex terminal. We ran a national mortgage company from one little screen with green letters on it, with nothing but numbers. And we were hedging our mortgage portfolio, our mortgage pipeline, our originations. We were setting our prices, pure and simple, based on the numbers that were coming across. And we didn't have one screen in every office across the country. We had one screen in one office. So the concept of hedging an asset is how I grew up, understanding the markets and looking at the markets. As that evolved, as I moved on to Citibank, we were managing, you know, a few $1 billion here and there that we had to hedge. And we still did not have an electronic market. I'm going back to the point in time where everything was traded. Basically, everything was traded from a financials perspective in the pit. And one of the things we had to do was try and figure out how to hide. And I mean that very seriously. We, at that point in time, were the largest mortgage banker in the country. We had the largest mortgage portfolio in the country. And we had to hide our trades because we couldn't go into the floor and take a position. So we had to come up with very different looks at the marketplace. And so we started reaching out to Europe. We started using the LIBOR and the LIBORs in general as hedges against the U.S. markets because we were trying to hide from knowledge on the floor. We didn't want the floor to see what we were doing. We didn't want the pits to know what we were doing. Now, let's go back now to 5 years ago, and I retired from banking, I did consulting, and I decided to become a trader. So when I was nosing around, I was looking for what Matt was saying, for somebody I could learn from that modeled in a way the kinds of experiences that I had had in the past, and that is understanding the fundamental structures of markets and figuring out a way to make money at that. And that's how I got associated with DTI. And so my first trading experience in terms of actively trying to make money in trading as opposed to hedging a position was with DTI. And I went to trade shows, and I talked to people. I wanted an organization or an area where I could feel comfortable that I understood the fundamentals of what they were doing. And so it was going back to the basics, as you say, Matt, with your grandfather, tape reading. And that's hard to get to. And visuals are nice. But for me, it was, I want to understand what's behind the visuals, and then I can use the pictures to help me further. So it's a little different background, Matt, but the concept is still the same. And so it's taken now, several years for me to develop, a real comfort level in terms of being able to look at the dynamics of the market whether it be with pictures or with numbers, and I'm sort of probably, you'd call me sort of a halfway in between. If you're at let's say if you're with in an educational environment that's very numbers oriented, I don't remember all the numbers. I have to write them down, and I like the pictures to look at. But I don't like my screen covered up with lots of waves going across it. So I'm sort of in between in that regard. And that puts me where I am today, feeling pretty comfortable in looking at numbers, markets, and pictures to trade. Morgan?
Okay, great. Thanks for sharing that, guys. And then one more question real quick, and then we'll get into kind of the meat of it. If you could, in just about a minute or less, describe, and Steve, we'll start with you on this one, describe your trading room / trading setup as far as computers, and give people just kind of a visual image of the setup that you have where you trade.
Well, I'm sort of the antithesis of what most people are. I have one computer, and occasionally I will link up a second screen. And I manage everything off of one 19-inch laptop most of the time. I made a conscious decision that I wanted to be able to travel. I still have work that I do in England, and I travel quite extensively. So I wanted to be able to be mobile. One of the reasons I went into trading is so I could trade from anywhere at any time. And so I sort of set a discipline for myself is keep your real estate small, keep your information manageable, and then be able to work within that. And a lot of people are surprised that when I'm working with DTI, I will actually be projecting my roadmap or basically my format to the room, to the whole world. I also will have the chat open, and I have my domes open, and I'm managing that on a 19-inch computer screen, because I have found, and I know you asked for a minute, Morgan, but this goes back to my days at Citibank. I would walk into a room in our trading floor when we were hedging, and I would go around, and we had, these guys had monitors. They had, 6 or 8 of them. They had all this stuff. And I would go over and I'd start asking them questions. I'd say, what is that? What is this? And they said, oh, I don't pay attention to that. Oh, that's an old. And I said, what are you actually looking at? And they'd point out 4, 5, 6, 10 things that they were really using. They were spending a lot of money. And in those days, I'm telling you, that was horsepower. In terms of, we had to have cooled rooms for all those monitors. But I found that they didn't trade with very much information. They just had so much information that they could sort of self-justify themselves. And so I made a commitment to have less information and more efficiency. Morgan?
Okay, thanks, Steve. And Matt, if you could just real quick describe the trading setup that you have.
Basically what I have is, I can relate to Steve's setup, because for 8 years I was on the road, basically living out of a suitcase, and I had to be on laptops. So everything was, central through a laptop. Now I'm at home because we use tools like Omnovia, GoToMeeting, things like that. I can connect with a client right away. So I have everything on 2 computers. One of them is devoted to all of my indicators and my screens. The other one has my brokerage platform on the other side, so I can execute orders. I keep them completely separate. They're not. I don't trade on the screen. Everything goes through my broker. It's the same broker I've had for the last 7 years. So try to keep it simple. I see guys that have these racks. They'll have 8, 9, 10 computers, all around. They like to be surrounded by this big horseshoe, and it makes them feel powerful and, totally connected. But, the bottom line is, at the end of the day, if you're not making any money, what good's all that doing? You got all this real estate on top of your desk, and it's useless. And I see a lot of that. I don't know if it's ego-driven or they feel like it makes them more powerful. I don't know, but I keep it simple. two screens. They're 30-inch screens, and each one of the computers is completely separate. I try to keep it simple. I have 4 indicators around my screen all times, and they're all related to my setup, and that's the only thing I use. If I have a setup, I have a setup. If I don't, I'm patient, very disciplined, and wait.
All right, good deal. Well, that's good. That sounds good. Matt, the first question will go to you as far as the questions we talked about in the email that we sent out. What popular indicators would you?
I actually thought about that, and I can talk about the negatives of just about any indicator, but the problem is that we're dealing with individuals, and everybody's different. So what works for one person is not going to work for the other, and that's fine. But the tools that I actually use should be incorporated by every trader. I don't know how they can trade without them, because, again, my situation goes back to risk management, so I have to use those tools that enable me to get the job done. To talk about and say, hey, stochastics, RSI, MACD, it's kind of like going into an ice cream shop and you got a bunch of different flavors. One works for one person, the other one doesn't. It really comes down to, what your belief system is. Because in the end, you're trading your beliefs. And if you get somebody that is a support and resistance trader, but their belief structure is that I'm trying to find a trend and I want to ride it, well, that support and resistance indicator is not going to be of any value to them. And vice versa. You find somebody that doesn't agree with trends, and they say, hey, I want to look at the pivot points. That's what I want to trade off of. I don't see anything wrong with that, but what I try to get back to with everybody is I say this. You never know how far a trade's going to go. So you have to let your trades run if you're going to end up paying for the losers. And, I see all these people trying to get 80, 90% winning trades, and, I don't have anybody in my Rolodex. And I work with hedge funds, private money managers, people that are running their own money management firms, and there's just, you don't see them trading at that level. I know people want to do that, and I did it in the beginning, and I blew out nothing but, my money, trying to be right. And I said to myself, I had a mentor one time tell me something that was probably the best piece of advice that I ever got. And it was, it doesn't matter how often you're right or wrong. It only matters how much you make when you're right versus how much you lose when you're wrong. And it took me a while to grab that concept, because I said, well, what does that really mean? I had a client this morning that had 3 losing trades. He lost $880, and I know he was frustrated. I know he was ready to stop trading for the day, and my advice to him was, you keep trading, because the market never stops. Even though you stop for your session, the next day is the continuation of the session. So I said to him, you keep trading. There's you're going to get a big winner. It's just a matter of time. Sure enough, the next trade comes in. He makes $2,440. So minus his $880 that he lost, he walks away with the day for $1,560. And, I told him, I said, get up and repeat the process. Because I said, that's what trading is. It's a business. You're there to make money, not to see how many times you can be right. Because that's your ego talking. Now you're not focused on the business. You're focused on being right. And, one of the things over 24 years of working with traders, one of the things I can tell you is that the vast majority of people or clients that I come in contact with are losing traders. And this isn't to say that they can't turn it around, but the 4 categories consistently losers are doctors, lawyers, accountants, and engineers. And people say, well, how can that be? Those people are extremely smart. Yes, they are, but they're probably the smartest group of the bunch. But as I've always said, trading and education don't go hand in hand. You don't have to be a rocket scientist to be a great trader. In fact, it'll probably hurt you. The flip side to that is the 4 best traders that I've seen come out of the marketplace are airplane pilots, ex-military, professional sports people, and entrepreneurs. And the entrepreneurs are risk takers. They understand risk. They understand that there's a certain amount of risk that you take for a reward. Airplane pilots, they go through an enormous checklist. It's all about discipline. Ex-military, follow the system or you die. You don't bend the rules or you go down in rank. Professional sports people, they go through an enormous amount of discipline and training. Before game day, there's an enormous amount of work that goes into that game. You only see 2 hours of them playing that game. But what they did prior to that week, that's where, that's the payoff. I mean, it's all about preparation and discipline. And if you can be patient and disciplined, you can be a great trader. Morgan?
All right, great. Thank you. And yeah, I agree with that. I think that regardless of what method you're using, whether you're looking at lines on the chart, watching numbers, using pivot points, a lot of the things you said, you've got to have that risk management, such a key factor, and or at least if you want to stay around in the business for longer than just blowing up one account and leaving, you've definitely got to manage your risk. So thanks for sharing that. And Steve, the first question to you is going to be, are there any approaches that are working for you in the current high volatility environment?
All right. Approaches that work, in my opinion, being aware of multiple markets, not being myopic. And when I say that, I so often see people that say, I'm going to trade the S&P, or I'm looking for this number on the S&P solely and alone, or I'm looking for this number on the Dow. And yes, those can be very, very good triggers. But one of the things that I've learned is the importance to at least be able to look, just like the roadmap, and if you look at the ETR page, I happen to look at about 6 charts. For example, in early bird, I trade early bird a lot. And the markets I'm looking at in early bird are the S&P, the DAX, the Euro stocks, the FTSE, the Swiss market, the NASDAQ, and the Dow. And I also have the dollar index going, okay? So those are my keys that I look at. And what works is to get agreement. If not specific agreement, directional agreement. And at different times throughout the morning, I put greater weight on greater action between those markets. In early bird, I am focused hugely on the DAX, the Euro stocks, the FTSE, and the Swiss market. Okay, those are where my focus are. Then I see, do I want to trade one of those, or do I want to use the Dow, the NASDAQ, or the S&P? So it's very much a synthesized look as opposed to a periscope or a telescope look. I'm not trying to look at one market. I'm trying to visualize all of those through the numbers. And so for me, it's trying to not get narrow focused. Try and keep a broad-based look as to how everybody's behaving. And then trade what I think is the best market to trade at that point in time. Now, once we migrate into our day market, the U.S. market, then I put onto, for example, the S&P as opposed to the DAX. But up until 10:30, I'm looking very strongly, Central Time, I'm looking very strongly at the DAX and the Euro stocks for direction. Once we get the European cash market out of the way, then the U.S. cash markets are very free. I use time to adjust my focus, but I'm still looking at those primary markets. Now, once 10:30 goes away, I then begin to put more focus, for example, on the JINT, the JIQT, the issues. But at the end of the day, it doesn't matter to me what the issues are doing. What matters to me is what the price is doing on the futures. And I'm very much a futures-focused person on a day trading basis. So I shift my view differently if I'm talking about equities. Totally different conversation. Long-term portfolio management, risk management on a long term. And I personally think it's hard for some people to have, in effect, 2 portfolios. It's sort of left brain, right brain. One is the current trading of today. I'm day trading today. I have to look at what's going on today, and I trade that. But if I'm going to have an investment portfolio of any sort, if I'm going to own any stocks, or I'm going to do options out, let's say, a month or 2 months, I need to think differently relative to those than I do to my day trades. And I cannot overreact to a movement in a day trade environment to the stock portfolio that I have. And I think it's that balance I struggle with it. I'll be honest with you. But keeping that segregation of sort of longer-term risk management as opposed to day trading opportunities with risk management embedded in that is so critical. But for me, it's not being myopic. It's looking at multiple markets and letting them work together and telling me when the market's giving me a trade. And I am looking for over 80% accuracy on my day trades. And I don't see a problem accomplishing that. That is obtainable in my opinion. Longer term is a very different story. Morgan?
All right, great. Thank you, Steve. And Matt, the next question goes to you. What powerful techniques do you find most traders are overlooking?
You know, that's an interesting question. Most traders, especially neophytes and people that have been in the business, let's just say you've been trading for less than 3 years. Typically what I find is that people don't focus on the two most important parts of trading, and that is the size, how many contracts they have on relative to the size of the account that they're trading. I'll give you an example. Let's say a trader's got a $10,000 account. Most of the time you'll see them trading 1 or 2 contracts. But in reality, they probably should have on 4 or 5, maybe even 6, depends on the position size that they're getting into. And that's one of the things that I concentrate, because they're leaving an enormous amount of money on the table. I see this happen all the time. The focal point that I see people that are overlooking is that you make money 2 ways in trading. It's your position size and your exit. You don't make money on entries. And if you look at what people do, the majority of the time is they put 90% of their emphasis on the entry. Well, getting into the market, most people don't have a problem. And if you ask the average trader, say, do you have a problem getting into the market? No. I mean, some of them are actually trigger happy. They like just pulling that trigger. And it just makes them feel good. I don't know what it is. It's maybe they're hyperactive. They had too much coffee. Whatever the case is, they just don't have a problem getting in. But if you go back and look at your trades, you make money on how many contracts you have and your exit strategy. And the question you have to ask yourself when you get into every trade, do you know exactly where that trade's going to end? Nobody does. And if they tell you they do, they're full of it. Because how many times have you gotten into a trade and said, you know what, I'm going to put my exit at 3 times my risk, so I have a 3-to-1 winner, okay? And he's using a profit target. Well, once it gets to that 3-to-1, and let's say you were risking $400 and you ended up making 12, you're happy. So you say, okay, I'm done for the day. But what happens when you watch that trade go to 20-to-1 and you leave an enormous amount of money on the table? How many times has that happened to you? My guess is that it happens to people every week. And that's when they start to get in and tinker with their system. Start buying different indicators, start testing this and testing that. Next thing you know, they've got a completely different system that they were using last week. And unless you have a set of strict rules that you're testing out on, and I'll tell this to people all the time, don't even talk to me unless you got 100 trades. Using the same system, you didn't bend the rules, you didn't change them whatsoever. Give me 100 trades, and then we'll analyze and see what's going on with your system. These people say, well, I made 5 trades, here's my results. That doesn't tell me anything, because the market works in cycles. And if you need evidence of that, just go back and look at 2 weeks ago. Did you have the same market that did you have this week? No. I mean, volatility changes, sometimes on a daily and an hourly basis. Getting back to the question, what powerful techniques do traders overlook? I have to say the risk management. I see folk, they have everything under the sun, but they don't have anything for risk management. And that's the key to this business. It's no different than being in the insurance business and you're an actuary, okay? If you haven't calculated the risk on this stuff, you're basically throwing cards in the air, and I don't understand that, because as a business, we have to be able to quantify what's going on in order to know what's wrong. Because a lot of times when clients say, I'm not making money, I'm not doing this or I'm not doing that, okay, let's go back and review the trades. They don't even have 15 or, about what's going on. In fact, I had one client that I had asked him, I said, save the results because I need to see what's going on. And he was taking his brokerage statements and shredding them so his wife wouldn't see them. And I was like, well, I mean, how am I going to, how are you going to work with somebody like that? And it's like, there's all this deception and hiding. It's like you can't do that. You've got to put it out there, and it's about responsibility. It's about facing up to what's going on. If the system doesn't work, okay, let's break it apart and find out what's going on. There's something wrong in that system. Either you're not executing the trade right, you don't have enough contracts on, you're not exiting the trade properly. There's a whole host of things that can go on with this. And I break it down to 4 simple rules or an approach to a setup. Number 1, trade with the trend. Follow the trend, because 7 out of times when you get a reaction to the market, it's going to go in the underlying trend that it's moving in. So be on the right side. Second, cut your losses short. When a trade's not working, get out of there. Don't rationalize and say, oh, well, I'll give it another point and I'll come back. I've seen guys with stock trades, they'll have a 2-point loss or a 3-point loss. Next thing you know, I call them up, it's down 8 points. Why are you hanging on to it? I mean, the rationalization game that traders play is just, it's phenomenal. It's just beyond belief. But you have to stick to the loss. When it gets to that point, you're out. You're done. Go find another trade. Some trades just don't work, and you can't put all your eggs in one basket. Number 3, let your profits run. As I stated earlier, nobody knows where a trade's going to end, and why not let the trade, because what I use is something called an ATR stop, and it paints red and blue dots. So if I'm going long the trade, all I do is simply watch those, and once the trade has a reaction down to the dot, I'm out. But if it doesn't hit the dot, I'll hang on to it. And for a day trade, I may be in the thing 3 or 4 hours. If it's a great thing, if it's a great runner and it wants to run, I'm going to let it run. Give it a little bit of room, but follow that ATR stop. And the 4th thing is probably the most important, and these are not all in an order of importance, and that is manage the risk. Managing the risk comes in 2 parts. First of all, your position size. Have the right amount of contracts on based on your account size. We have a risk management tool that does that. All of this is automated. It's under our DTS trading system, and you can go to the Indicator Warehouse website and you can see it. There are 4 simple tools that make this system work. And in doing managing the risk, you have to put on the right amount of contracts. That's the first side of it. The second side of it is managing the risk means knowing how to exit the trade, letting the trade run if it's in a move. If you get into a real long trend that's very powerful, I'm telling you, there's nothing greater than cashing in for a trade that's 25 to 1, because that's going to pay for a lot of losing trades, and it's going to put you on the plus side. But it really breaks down to those 4 principles: trading with the trend, cutting the losses short, letting the profits run, and managing risk. I say those are cardinal rules because without them, and these weren't just something that I pulled out of a hat. These rules came from working with consistently profitable traders. Because in the beginning, my whole focus was, I'm tired of buying indicators. I'm tired of listening to Tom, Dick, and Harry tell me what to do. I want to find somebody that knows what they're doing, and I want to replicate that system. I mean, that was the bottom line. I was willing to throw everything out the window and start from square one, because you know what? I had to make money. I was tired of sitting there. It was like being on a treadmill. You're going faster and faster and faster, and you know what? You realize, hey, I'm not moving anywhere. I'm in the same place. At some point you wake up and you say, if I'm going to continue to do this, it's got to be profitable. Otherwise, I'm wasting my time. And unfortunately, a lot of traders have to get to that point. I think they either blow out or they just get to a point where they're like they can't do it anymore because they're tired of being in that constant discovery mode. You know, oh, there's a new indicator. Let's try this. Oh, let's try this. You know, that's not recording your results. You know, you try it for 2 or 3 trades and then you throw it out the window. You haven't gained anything. Like I said, put on 100 trades, then we'll analyze it. You may find out, hey, this is a great indicator, or you may find out this thing isn't worth, you know, the paper it's printed on. So it's really, it's a process where you have to have rules and a structure to follow. And when you follow that structure, it leads to the path of profits.
All right. Thank you very much for sharing that. Yeah, we appreciate you sharing those rules. I think that's helpful for everybody. So again, just to recap, it was trade with the trend, cut your losses short, let your profits run, and then manage your risk as well. So thanks again for sharing that. And then Steve, the last question's going to go to you. It's what kind of methodology works best for your trading overall?
Oh, patience. Patience. I think patience with education, it takes time to learn. Patience with a new indicator or a new concept. As Matt was saying, I have watched people literally try and absorb every possible indicator on the planet. And they will try this for X amount of weeks or months, and then they jump to this one, and then they jump to that one. There are many indicators that people are successful with, but they tend to, if they're successful with it, it's because they learned them well, they understood their own emotions and dynamics working with that indicator, and they've learned how to make it work. What I see the biggest problem is not spending the time investing in learning what it is that you are going to commit to. Different football teams have different, offensive strategies. They have different defensive sets. And depending on the personnel in place, they're successful. They may be different schemes, and you cannot necessarily take that same scheme and transfer it over to another set of players. Each individual has a different way of looking at the market, in my opinion. So what works best for me is to set up a fundamentals framework that I'm comfortable with, that I've learned to be comfortable with. And then, as Matt is saying, I'm looking for great entries. Entries are the key. Particularly the earlier in the day, the more important those entries are in terms of being able to let them run. Second point, and I'm playing off of what Matt was saying here, one of the biggest problems is not carrying your ego into a trade. This is not prom king or queen voting here. Okay, this is not best to succeed. This is making money. And if you carry your ego into the trade, I think you're creating a problem for yourself. You have to be able to say, oops, I'm going to scale out of this thing. The risk is no longer acceptable based on whatever indicators you want to use. Now, mine happens to be multiple markets. Multiple markets are my best tool, multiple markets and their price. And being able to say, I just got this sucker wrong. Take your licks and get out. I'm not as good as letting things trail up as I would like to be, playing off what Matt's saying, because I then start looking at where am I going to get support or resistance. And I want to have most of my contracts. I'd like to have at least 2/3 off so that I'm working with, 1, the market's money, 2, I have the chance for the runner. 2/3 could be I had 9 contracts versus 3 contracts. That depends on your account size. But the concept remains the same. And always and foremost, do I know when I'm wrong? At what point do I know when I'm wrong? And that's the system that I have found to work the best. And I'm not taking away from the Fibonacci's, the Elliott's, the stochastics, the SMAs. Okay, I'm not taking away from those. Because if they're working, the one system to not use is the one that you've worked on for a reasonable period of time and you can't make it work. It just doesn't fit for you. But to bounce around systems and indicators is worse than trying to learn one and losing money at it. And like you say, Matt, This is a business. I don't know many businesses, whether it's a restaurant that tries to get their menu right or their service performance correct, or whether it's somebody that's inventing a new product. Any business takes time to evolve. It takes time to understand the dynamics between yourself as a personality, the organization as a group of people, and the marketplace. And that adaptation process is a very personal one, in my opinion. And I don't say to anybody who's successful that they're silly for using a fib. Anybody that's successful should continue doing what they're doing. If you're not, then you expand that knowledge slowly, carefully. Morgan, you know for a fact I blew up a couple of accounts in my first year of trading, okay? And I did the over trading, and I took my egos into trades, and I could overtrade to beat the best of them because I knew I could beat this market. And bottom line, I figured out it doesn't work that way. Doesn't work that way. And so patience and not taking your ego into the trade, risk management, and find what works. Those are my thoughts.
All right, great. Thank you very much, Steve. We appreciate both you and Matt joining us today. And again, if you'd like to get more information from either of our speakers, you can find information on Matt at www.indicatorwarehouse.com. And if you'd like more information on Steve Thompson, go to www.dtitrader.com. is the company that Steve is a student with and has been from 2006, Steve?
Yeah, it's been about 5 years.
About 5 years, and he's a regular in the DTI trade room. So, guys, we really appreciate you taking the time to be with us today and join us. I know that everybody enjoyed that presentation, and you guys sharing just from some of the struggles you had as a trader and some of the successes you had as well. I think that's very important and can be very beneficial for a lot of people out there that are trying to either become a trader or that are already trading and trying to do better and better each day. So again, thanks again for sharing that. And I think there's just a tremendous amount of information that you guys shared. We appreciate everybody being with us. And if you would like to join us for the next Trading Pub event, I'll type in a link to do that as well. So again, thanks to everybody for joining us today. And here's the link if you're interested in registering for a future Trading Pub event. Hope you guys have a wonderful rest of the day.